Alright, so after watching this video, you'll understand what a holding company is and when you might use one here in Canada. So we're going to look at the 5 reasons you might want to have a holding company here in Canada and also some disadvantages to having a holding company. So what is a holding company? A holding company is just a company that holds investments rather than an operating company which runs the operations of a business. So a common difference would be maybe a bakery or something that runs their business. They may have an operating company that brings in the money for selling baked goods, but they might also own the building that they're in, and that might be held through a holding company. But holding company investments can come in many forms. Real estate is one common example, but it can be something as simple as shares or stocks or bonds or mutual funds. Those are all considered investments and would all be held within a holding company. But the main investment that we'd be looking at for Canadian small business owners is they would hold the shares of a private operating company. So we have a structure where the operating company is at the bottom, a holding company owns the shares of that operating company, and then the owner owns the shares of the holding company, and therefore all 3 entities. Now, why would you have a holding company here in Canada? We're going to cover 5 of the most common scenarios that we see where people can use a holding company. I'll cover these quickly right here, but we'll cover them in more detail right after that. So number 1 is asset protection. We want to protect the assets that we've built up within the operating company generally. We want to protect those from legal liability. Number 2 is to help us claim the lifetime capital gains exemption. The lifetime capital gains exemption gives us an exemption from some capital gains within our operating company, so we can use a holding company to help meet some of the criteria that this exemption requires. Number 3 is tax savings. There are some scenarios where corporations pay lower tax rates than personal individuals on investment income. The number 4 scenario is tax deferral. We can be a little better at planning if we have a corporation on when we take out money personally from our corporation, especially when there's other people involved. And number 5 is estate planning. Planning to pass down your company to a son or a daughter or another family member. You can use a holding company in order to affect this in a tax efficient way. Alright, so let's cover number 1, which is asset protection. We want to protect the assets that we've built up in the operating company from legal liability. Because operating companies do the work and generate the income for most companies, they can also bring on additional risk. So let's look at an example of where an operating company doesn't have a holding company and where that might create some risk. So we're going to look at Bob's Construction Company, and he's in Vancouver, BC, and they do electrical installations. Bob Loblaw, the owner of Bob's Construction Company, has owned the business for 10 years. So since then, it's become quite profitable, and in the last 4 years, he's earned $250,000 in profit after paying his salary. So those profits have stayed within the business, and now he's built up an investment nest egg within the company of $1 million over the last 4 years. Now, a year ago, Bob's Construction Company finished a job on a Vancouver commercial building and installed the electrical equipment. It turned out it was some faulty work though, and after a short circuit or something, the building burned down, and they realized that it was because of Bob's work. Now Bob's Building Co. is being sued by the company that had the building built, and his $1 million nest egg is at risk. Now let's rewind the clock, and 10 years ago when Bob set up this company, he created a holding company as well. And over the last 4 years, he's been paying intercompany dividends to that holding company via a tax-free dividend. Now, dividends paid between corporations that are owned by the same people can be transferred tax-free. And now, because Bob has been diligent in sending this money over to the holding company, it now has an additional layer of asset protection than it would otherwise. And the company that's suing him has a harder time getting access to those assets. Now let's look at scenario number 2, which is helping us gain access to the lifetime capital gains exemption. Now, the lifetime capital gains exemption provides an exemption from tax to owners of Canadian controlled private corporations, which is most companies here in Canada. And it provides us with tax-free capital gains of up to about $900,000 in our lifetime. So yes, you heard that right. There is an opportunity to save taxes on almost $900,000 of income. Now, to gain access to this lifetime capital gains exemption, there are obviously some criteria that must be met. And number one is you must be selling the shares of your company. Now, the company itself must meet some criteria as well. So number one is the asset test. And this is at the time of this share sale, you need to have 90% of the assets used in the active business. Essentially what this means is you can't have too many investments within your corporation and still qualify for this exemption. The next criteria is the basic asset test, which is that the majority of the assets within the company, so more than 50%, have to be used in active business over the last 2 years. At all times through the last 2 years, you can't have investments that are valued at more than 50% of the overall assets. And lastly, there's the holding period test. So you have to have held these shares for a 24-month period or 2 years up until the date of sale. All right, so how does a holding company help us meet these criteria? So let's look at another example, and let's look at Aviato Inc., which is a Canadian-controlled private corporation owned by Erlich Bachman. Now, Erlich has started his company 4 years ago, and it's a software company that scrapes the internet for negative reviews on Air Canada, posts them to its website, and then sells advertising to other airlines here in Canada. So Aviato has created $250,000 in profit over the last 4 years. The remaining cash, so the cash he's generated from this profit, has remained within the company and he's put it into investments. So now Erlich has been approached by a group of investors that want to buy his company for $800,000. Pretty nice. Now, all things being equal, he bought his shares for $1 from when he started his company, and now he's selling them for $800,000. He has a gain of about $800,000. But if he could qualify for the lifetime capital gains exemption, this gain would be exempt from tax and he'd pay $0 of tax on this transaction. But in this example, Aviato doesn't have the basic asset test done properly, so he has more than 50% of his assets in passive investments not used in his active business. So instead of paying $0 in tax, because he hasn't met this criteria, he's going to pay $166,000 on this transaction. All right, now let's bring in the holding company, and let's say that Erlich was forward looking. He thought he was going to sell his shares in a couple years, so he created a holding company and started pumping money into this holding company when he had profit to do so. Now again, he's got the money over to this holding company through a tax-free dividend by intercompany dividends, and he's paid no tax on that so far. Now the holding company holds $1 million in assets, these investments, and they pay their taxes on any investment income. That's all normal and fine. But the upside is now that Aviato Inc. has been cleansed of these investments, it meets the basic asset test, and now Erlich can sell the shares of this corporation and get the lifetime capital gains exemption, and he pays $0 in tax on that transaction. Perfect. All right, so let's move on to scenario number 3, which is tax savings. Now, there are some opportunities for tax savings by putting your investments within a corporation. These have been quite limited recently with some tax rule changes, so something really just to watch out for. Now, this area can get quite complex, so it's hard to get into details about this in a video like this, but you just have to know that there are some tax savings to be had, but they will vary based on the province that you're in, your own personal tax income, and the type of investment income we're talking about. But as before, I think an example is going to help clarify this situation. So let's talk next about Harvey Specter. He's a successful lawyer in Calgary, and he earns about $350,000 in salary each year. He also has an investment portfolio that he holds personally, and he earns about $50,000 in investment income every year from that as well. Now, because Harvey's employment income is so high, he's in a really high tax bracket, and that $50,000 in investment income, he's going to pay at the highest marginal rate. And in Alberta, he's probably going to pay around $24,000 in tax on this $50,000 of income. Now, if he's in BC or Ontario, he could be facing upwards of 53.5% tax on this additional $50,000 in income. But now let's look at the scenario where he has a holding company and these investments are held within the holding company. So in this scenario, he's going to have the same $50,000 of income, but he's going to pay about $19,000 in taxes. That's a $5,000 tax savings, and he can use that money to reinvest and grow his portfolio. All right, so let's move on to scenario number 4, which is tax deferral. That is pushing our tax bill down the line to future years. Now, this is a really important factor in any sort of tax planning, is that the longer that we can hold on to our money, the more we can make it grow. And yes, we have to pay tax on that in the future, but we're not paying it now, which is a good thing. So now let's look at Sterling Cooper Inc., which is an advertising agency in Toronto. Sterling Cooper has 3 owners, that's Don, Bertram, and Roger, and they each own 1/3 of the company. Now this year they've been pretty successful. In 2020, they earned enough money to pay $100,000 dividend to each of the owners. Pretty good. And if you're not sure what a dividend is, check out our video. I'll link it up here and take a look at that. It's been really popular, but it explains what a dividend is and dividends versus salary and how to take money out of your corporation. All right, so back to our scenario though, we're looking at Don, and Don has some side income in 2020, and he doesn't necessarily want to take this dividend this year. This dividend is kind of a worry for him from a tax perspective because he's had a really high income already this year. Now, because he has no say, all the other owners want to take out this dividend this year, he's going to pay a really high marginal tax rate on that income, on that dividend income, and that's just lost to it. Now, Don knows in 2021 his acting gig is going to wrap up and he's not going to have that income. He's going to have lower income in 2021. And with a lower income comes a lower marginal tax rate. So if there's any way he can push that to the following year, he's all for it. So now let's say Don has a holding company and the holding company owns his shares within Sterling Cooper. Now we would use that same intercompany dividend, pay that to the holding company, and that dividend would sit there until 2021 when Don wants this money. At that point, we would send the dividend to Don personally and he would pay his personal tax rate on that for 2021. Now this is a good scenario for a couple reasons. One, we don't have the tax bill right now, which is a good thing. He obviously doesn't need the money. But number 2, now he has a lower marginal tax rate. He's going to pay overall less tax. All right, so let's move on to scenario number 5, which is estate planning. So holding companies can be used to smooth out the transition of a company ownership from one generation to the next. And in this scenario, we're going to look at Tom Callahan Sr., who owns a brake pads manufacturing company in Manitoba. And he has a son, Tommy Callahan Jr., and he wants to transfer all of his ownership to the company over time to his son. Now, Tom Sr. has grown this business from the ground up, and now it's worth $3 million. And now while Tom Sr. wants to bring in Tommy Jr. into the company, he feels he's not quite ready yet to take the reins. He just wants to make sure he's setting him up for success for the future. Now, this is a scenario where we would create a holding company, and what this holding company can do is establish an estate freeze. Now, an estate freeze will allow Tom Sr. to freeze the value of his shares in time, and all the future growth of the company will go to Tommy Jr. And this type of transaction also allows Tom Sr. to remain in control of the company until Tom Jr. is ready to take over. Now, this also limits the tax liability that would be due upon Tom Sr.'s eventual death. Unfortunate to think about, but as accountants, that's our job. Now, Tommy Jr. is being successful in his role. He's seen lots of growth within the company, and that's all flowing to him, where Tom Sr. is able to guide him through that, but his value has been fixed at a certain date, which is perfect. All right, so now that we've covered all the scenarios where you would want to use a holding company, and if you have any other suggestions for why holding companies might be used, please post them in the comments below. We'd love to hear about it. But let's cover some of the disadvantages now. Why would a holding company not be a good idea? All right, so a lot of these examples are going to be covered or are going to cover the same ground as our incorporation video. So if you haven't checked out our incorporation video, I will link it up here. But also, let's talk about the disadvantages to a holding company here right now. So number 1 is incorporation costs. So you will have to pay to get your company incorporated. And there's a couple ways to do this, of course. You can go through the lawyer, which tends to be the more expensive route, but you can go through online services. We'll link down below to an affiliate link for Owner, which manages the incorporation process for you all online. But there is some cost associated with this, so it's just something to consider. Number 2 is ongoing costs. So you will have to pay for a few things to keep your corporation up and running. And that number 1 would be just your annual filing. So you need to keep your company in good standing and registered and file an annual report every year. But you also have to file corporate tax returns as well, which is an additional cost on top of that. Not to mention that it is just expensive to run an entity, a legal entity in Canada or anywhere else. Number 3 is administrative burden. So with any company, of course, you're going to have things that you just need to take care of, and that can cost you a lot of time. So it's just something to consider. If you have another company, it does come with more administration. Number 4 is complexity. As you create more complexity in your corporate structure, you're going to have more things that you need to take care of, more tripwires that can come into play. So it is important to engage with professionals on this stuff so that you don't fall afoul of any rules. And number 5 is you might pay more taxes. If you're not covering this really carefully and you're not consulting an expert, you may have scenarios where you actually pay more in tax by having this holding company. So you have to be really careful of where this might come into play, and please, please, please engage an expert on this. All right, so that's it. I hope that's given you some knowledge on what a holding company is and what it's used for here in Canada. And how about you? Do you have a holding company? Are you looking at getting a holding company and creating a more complex corporate structure? Post in the comments below. We'd love to hear about your experience with having a holding company and where it might have been helpful or a hindrance to you. And if you thought it's about time there was a channel like this specifically for Canadian small business owners, please subscribe. We'd love to have you around the channel commenting and watching our videos, and you can always request videos from me. I love to do these videos and keep the community informed on what's going on. So please subscribe. We'd really appreciate it. And if you like this video, please do us the favor and just hit that like button. It's super simple for you and means just a ton to us. All right, so that's it. Thanks for watching, and we'll see you on the next one. Cheers.